Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Hope you all had a wonderful 4th of July holiday as we get right back to it this week and take a look at several points we've been looking at. We're going to look at the first half of the year and the performance of dividend-paying stocks. Take a look at gasoline demand, all right, July 4th, always a busy travel weekend, and just kind of show you in a broader scheme where we're at in terms of gas demand. Andrew then is going to cover new highs in the market and volatility, his favorite topic in the planet, I do believe. So we'll start right off with dividend stock. So this is a performance. If you take, so the S&P 500 is full of stocks. Some pay their dividends, some don't. There's nothing inherently bad about not paying a dividend, by the way. Sometimes if you've got a lot of growth opportunities, it's better to hold on to that dividend and reinvest it back into the company. So it's not inherently a bad thing. Dividend-paying stocks do tend to outperform over time. But here's a look at if you just take the dividend-paying stocks minus the non-dividend payers, we're looking at a pretty sizable difference in performance if you look at this year. In fact, you have to go back to 2009 to find where the spread was this large. And this is just one more picture and the theme that we've been looking at all year for some of the high-flying growth stocks doing so much better. But 2009, we were coming right out of the great financial crisis. So a lot of those non-paying dividend stocks weren't necessarily your growers, but they were those that were struggling. So they were really, really beat down and had an astronomical start to the year in 2009. So we're back in that type of category. It would be more normal to see that spread compressed. Doesn't mean that it has to. But over time, there is some moderation. In fact, just one more point to this, your high dividend payers, which aren't necessarily always the best things to grab, but those high dividend payers only recently came off of their October lows, just to give you a sign for how big that difference has been, where a lot of the market is, of course, well off of those October of 2022 lows. Flipping the page now and taking a look at gas demand. So just over time, the population here in the United States grows. We tend to add economic activity, which means more miles traveled. And then 2020 hit and the pandemic changed everything. And of course, all along those growth years, you of course have more fuel efficiency that seems to be happening at an accelerating rate right now. But what you can see here is the total gasoline demand. Each year has a different color. If you look at 2019 is the green line. So that kind of sets your base, right? That was pre-pandemic before the world really adjusted. So we're looking at comparing here where we stack up against that prior high. 2020, as you can see, was just like most years where we were incrementally adding just a little bit of gas demand and then it just fell off the earth. So it's interesting to see where we are now. We have seen a lot of recovery, people beginning to travel. But that is more than being offset by fuel efficiency. And of course, the work from home phenomenon not only hurts office buildings, but is also acting to keep gasoline demand back. So we'll see. There is a camp that certainly believes that 2020 marks the absolute peak in terms of gas demand, and that we'll continue to see EVs and such and fuel efficiency totally keep us from reaching that prior high. That remains to be seen. But so far, we are, even though the recovery, we are staying below that 2019 demand, which I found sort of interesting and may, and at least in some part, explain why oil is struggling to find some footing, even though there's been some oil output cuts. So, Andrew, I'm going to turn the screen over to you, go from gasoline demand and take a look at and update us on these new highs.
Yeah, not only did gasoline demand fall, you said fell off the earth. If you remember back then, I know you do, and probably a lot of the watchers do as well, oil prices fell off the earth too. We went negative during that time period. Yeah. I'm going to go out on a limb and say that was probably a low when oil went negative. Might be aggressive, but that's going to be my call. But as I said, shifting gears, looking at market breadth, looking at new highs, something we spend a lot of time talking about. I share a lot of breadth charts in our allocation meeting, share a lot of them each week with you all on the Market Carver, because I think it's really important to understand how individual stocks are performing. One of the themes in the first 6 months of the year was we really weren't seeing a lot of strong breadth numbers. We weren't seeing a lot of participation as the market, as the S&P was going higher. We weren't seeing a lot of stocks joining that bandwagon. In doing so, it was really kind of focused on just a handful of securities that was driving that market higher. Thankfully, that's begun to change, and we're very encouraged by that. We're starting to see more stocks making highs. Today, I'm looking at just the number of stocks that are making 3-month highs. So I know there's kind of a lot going on in this chart. On that top panel, we have the S&P 500, and that green line is showing its 3-month high, red line showing 3-month lows. And then we have the percent of stocks that are making new 3-month highs, new 3-month lows, and then just the difference between those figures. What we want to see in a healthy, strong, rising market is more stocks, obviously, making new highs. And as you can see, if we look at the far right end of that chart, that's what we're starting to see. We're seeing an expanding number. Almost to 50% of the market is making a new 3-month high. If we then look at the very bottom panel, the difference, the highs minus the lows, we can see that for a lot of 2023, we were in the red. We are seeing more stocks making 3-month lows, and that's where our concern was. And we're starting to finally see that turn green, meaning we're starting to see more and more new highs versus new lows. And that's a strong characteristic of a healthy market. We're finally starting to see that. Now, this isn't used as a market timing tool, but this is just a way for us to take the temperature of the market to see how healthy or maybe how sick it is. And so we're encouraged, like I said, we're encouraged the fact that we're starting to see more stocks participating, more stocks hitting 3-month highs, and supporting what we're seeing in the broad indices. Now, there's our bullish point. There's our good sign. Unfortunately, now we have to go to the next slide, and that's going to look at volatility. In 2017, I won the Charles Dow Award for a paper I wrote called Forecasting a Volatility Tsunami. In that paper, I looked at what was a common characteristic for the volatility index, the VIX, which we consider like kind of the fear gauge of the market. When the market gets a little fearful, starts expecting a lot of ups and downs, we see the VIX start to spike higher. And we use this tool as a way to manage risk within the portfolios. So in my paper, I tried to look at different commonalities of what preceded these big spikes higher. And that's what I do a big deep dive in. It's a lot of pages, it's a lot of research, and found that when we start seeing compression in volatility, think of it as holding a beach ball under the water and kind of that buildup of pressure. And when it finally releases, we see these spikes. And it's the same type of thing was when we see it in the volatility index. When we see it compress and we don't really see a lot of movement in the VIX, in the volatility index, that's what kind of opens the door for a potential spike higher. And we're starting to see that today, unfortunately. In fact, we're seeing the compression there is actually the lowest since just before the COVID crash. Obviously, we're not expecting another worldwide epidemic, but we are seeing that we view this kind of as a gauge on sentiment, that when we're not seeing a lot of activity in the VIX, when the standard deviation begins to compress and get really, really low, that it's kind of a sign that there's a little bit too much exuberance in the market, that the market's a little too confident in the short term, and that overconfidence obviously then can cause some mean reversion, meaning that maybe the VIX does have to move higher, get a little bit of the market back to an even keel. And so we've seen in the past when we get these compressions, and I've put orange lines on the chart to help better explain it, we do see the volatility index move higher. And so again, I said we use this as a way to manage risk within the portfolios. We take this into consideration with kind of our shorter term positioning and maybe decisions we want to make or maybe don't want to make in the next several weeks. So we don't make major changes off of this type of development, but it is one of many, many, many resources that we take into consideration every single day, every week, every month, as we evaluate the best way to be positioned within our various core models. So right now, we kind of do have that doors opened for a move higher in volatility, and we're being cautious towards that. But we still are concerned very positive about the improvement in breadth that I shared previously. That's a little bit longer term looking. This VIX chart's a little bit shorter term, so that's kind of the best way that we gauge it. This is short term, the other one's long term, and so we kind of take it all together in our decision making.
Very good, Andrew. Very well put as always. And just one thing to share with the folks as we go in July, because this was a surprise to me. Right, one thing I love about this industry, there's always something new, and you shared with us last week that July tends to be one of the better months seasonality wise. So
Yep.
in terms of the many things that we look at, that one took me by surprise because I heard sell in May and go away right when I got in the industry. And more times than not, that's turned out to be like not great timing advice, but generally speaking, seasonality has been weak in the summer months, but July stands out. So we will hope here that the long-term significant positive news you shared with us prevails. And maybe this compressed volatility gives us an opportunity to add. We will see, but that little tidbit surprised me, and we'll take it if we can get another good July. So, as always, we really do appreciate you giving us a few minutes of your time here as we share our thoughts and keep you posted as to how we're progressing and what we're thinking about. As always, don't forget to give us a call if we can be of help, 800-928-4001, or of course, scan the QR code and book it electronically. So thank you so much. Have a great weekend.